Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value, and we're looking for, so my thesis really depends on an inflationary environment. If we don't have an inflationary environment, the thesis doesn't make any sense, and we have to exit our positions. I've been listening to a lot of different opinions. There's a lot that say we're going to have a deflation. There's a lot that say that we're going to have inflation. And I'll just, I've got questions. There's questions in the comments area. Is inflation transitory? Is it this? Is it that? I'll be honest. The way the thesis is developed, and I can go over it a little bit through some slides here, is it's based off of residential real estate land values. Residential real estate land values have been going up because we have a shortage of homes. We didn't build enough homes in the, we'll call it recovery phase. They went way, way low. We had a bunch of foreclosures, and it basically screwed up the housing market. I don't know if those people that have these opinions, I don't know if they know what I know. They can have doctorate degrees. Usually what happens is you almost split. You've got the real estate guys who know real estate, and you've got the financial guys who know the finances. Almost no one crosses over and looks at both sectors and tries to overlay them. Very, very few do that. I almost hear hardly anybody. Now, when I looked at it, it stuck out very well that when you compare residential real estate values with crashes, it's kind of like there's an obvious correlation. This isn't like, oh, it's weird how every time the housing starts go down, we have a recession every single time almost. It'd be an anomaly to not have one. Now, if that's the case, then deflation comes from residential real estate, and so does inflation, just by looking at the data. I don't need to know anything else. So, is some of the inflation going to be transitory? Maybe. We may have higher rates in the beginning, and then it may cool down and go down. But here's the thing. If you know how to read charts, if you look at history and look at a whole bunch of charts, I'm talking hundreds of thousands of charts is probably what I've looked at. When you break a massive pattern, it is so rare to go up like a teeny little amount and then just have it fall right back down and be done. It is very rare for that to happen. And we are breaking the biggest patterns I've ever seen everywhere. So I don't know if these people online on YouTube know how to read charts, if they even care, and if they see this. I don't know. And some people will say that the fundamentals drive things, technical analysis doesn't. I would argue that the fundamentals are what make up the technical chart. And the technical chart is the fundamentals being described in a chart of every single participant in the market interacting together. So if patterns repeat themselves over time, and if the fundamentals are baked into the participants interacting with each other, it will create a chart that we've seen in the past, which can more than likely predict the future. Because if the pattern repeats, it gives you herd mentality. And if herd mentality repeats, you have your fundamentals baked in the cake because everyone is interacting with each other with, I would say, close to the same data. And the market is basically your final answer. You can't create a narrative. You can't use certain data, run it through your head, and say this is right without the market verifying it. So you almost have to use the market for your data to verify and to verify whatever thesis that you come up with. So if your thesis is derived from market data, you're going to have a better thesis than someone who has a thesis that isn't derived by market data and data points. Now, there's multiple ways to look at all these things, and I may not have the right answer. But it's quite compelling to look at some of these charts with the patterns that they have. And what I mean by patterns, I'm talking they all have it. This isn't just one pattern. This is the dollar falling. This is platinum going up, gold going up, silver going up, the CRB index going up. This is oil breaking patterns. This is uranium starting to put down patterns. I don't know how all of those markets could be throwing basically a clear signal on everything and have it all be wrong. And some of these patterns are massive. I'm talking from the 1970s till today. And I don't know how that herd mentality, the herd basically setting up to launch these things to the moon, could all be wrong. And that's where it's funky. Now, we may have to endure short-term pain. We might have a short-term deflationary problem, or we might see a short-term real estate pullback from forbearance or moratoria. It very well could happen. I don't see that as a huge necessarily problem where I would be necessarily scared out. But I've got this thing. I'm going to show you some things, and a lot of people, it's like they've got data, and they're like, this is the longest stock market boom, and they don't know why it's long. They don't know. They don't explain it. They don't go in the data. They don't dig through it and sift through it. I did that somewhat. I'm not saying that I dug through all of it, but I've got some answers, I think, for some of it for you guys. And here it is. All right. Here's some of the answers. So this is, again, the new privately owned housing unit starts. The average is the big red line that goes across the entire graph. The graph is the real estate cycle. So these are new houses being built. And this is just how many new houses are being built over time. That's all it is. So we're building all these houses, and this is the real estate cycle. It's the recession, recovery, expansion, hyper supply phase, recession, and it goes over and over, and it cycles back and forth. And what you see in these periods back here, I put these little red arrows in here. This was the recovery phase length in the housing market. Really short, really short, really short. We had a longer one in the 1990s. It was a recovery phase here all the way till about 99, 2000, or 98, 99, somewhere in there, where we went into an expansionary phase. And then we had a very long one here from about 2009 all the way to about 2020. That's where it popped up, and then they had the COVID. So this is the reason right here in that big long recovery phase where inflation's low and interest rates are low. That's the reason why stocks went up so much. Now, the stock market is in total bubble land in terms of price to earnings ratios, which is that's called the CAPE ratio. The CAPE ratio, which is the price to earnings ratio, is way up there. It's like 30, it's in the 30s, 35, 36, 37, 38, somewhere in there, which is complete bubble land. The highest it's ever been is 44 in the NASDAQ bubble. And the reason it's up there is because interest rates are so low. Interest rates is a discounting mechanism for net present value calculations, which if you put it all the way to zero, it prices stocks higher. Now, if that reverses, so do those valuations. They'll reverse downward. So I'm going to go through a couple more slides here real quick. So this is the 10-year U.S. Treasury yield, and it's been going up. It came off the bottom pretty good, and it's been rising quite dramatically. What this signifies is that people didn't want to hold bonds, and they expected that inflation was going to come. Now, when people get afraid, they go back into bonds, and they were getting afraid, and then they broke out to the downside here for whatever reason. I don't know if somebody's in there manipulating this stuff, or if there's a genuine concern about bonds. Now we broke this uptrend line to the downside. Usually, what that is signaling is that we need to start watching our copper to gold ratio. If the copper to gold ratio starts to really decline, then we may have a short-term problem or a problem in general. Now, should we be worried about this? This is what makes this is confusing here. We just posted a CPI number of 5%. And 10-year bond yields went down. How is that possible? That is confusing to me. That doesn't make any sense. Doesn't make sense. Now, I'm going to show you TIPS. TIPS are correlated. This is Treasury inflation protected securities for bonds. TIPS. Now, there's a high correlation between TIPS and gold, and I'll show you that correlation in the next slide. But here it is right here. This is our iShares TIPS bond ETF. We broke to the upside in this clear break right here, and we've been moving higher. We are still in this uptrend, which is a steep uptrend. And even if this breaks, it's not the end of the world. We've got other support down here. We can go all the way back down, to this line as well, to support. This is all support over here. And I expect it to come back down a little bit because it's been on a very steep uptrend. So we've got TIPS going higher. They've gone sideways probably for a little while when gold goes sideways, but it's gone sideways and then they've been going up. We've got the iShares TIPS bond ETF here against GLD. I just put them against each other, and all GLD is it moves greater than TIPS. It's more volatile. So it moves at an increased pace of TIPS, but you can see that they're correlated everywhere. I mean, you can basically see the general trends are correlated. So we've got TIPS going higher. It broke out to the upside. So TIPS is signaling that it's game on for an inflationary environment. Real estate, housing starts, is game on for an inflationary environment. But yields are going down in terms of the 10-year yield, which is weird. Now, the copper to gold ratio also tells us data. I'm going to go back here and read what it means. The interpretation here is gold is the most widely recognized safe haven asset among investors. Therefore, during times of economic and geopolitical distress, it generally tends to perform well, making it a leading indicator of fear. Copper is the exact opposite. Because it's a key industrial metal that is used globally in a wide range of industrial applications, it performs strongly when the global economy is firing on all cylinders. This makes it a leading indicator of global economic health and has led it being commonly called Dr. Copper. The ratio prices copper and gold and represents the number of ounces of gold it can take to buy an ounce of copper. And usually this ratio, and you can see the ratio, I put the downtrend there. What's insane here is this is from 1971. We came all the way down, it's gone sideways, and we just broke to the upside. And that's why we've seen such a strong move in copper. It is breaking a massive pattern. The herd has kept this down. We've sold it, not cared about it for so long that finally people are caring about copper and they're bidding it up, and the market conditions support that bidding, the higher bids on copper. Now, I can't envision this breaking out to the upside and going nowhere, breaking a pattern that large. I mean, I can put other patterns in here. There was another pattern that was broken. I'll do it right now. When that pattern broke, you see when it broke, came up, hit it, and broke, and it ran. Now, we could easily pull back, but this thing just didn't stop. It ran. And then when the uptrend was broken, it was over. That uptrend broke and it was done. But notice that these are very long patterns. This is a massive pattern back here. It broke and it just didn't stop. It was saying something. We've got the pattern again, which is massive here, breaking to the upside. I don't think it's just going to stop. The likelihood is very low of that. And we haven't seen that in history, where you break a 30 or 40-year pattern and it just stops. But we're seeing it across all the equities. We're seeing it across all the materials. Now, I'm going to go down here. I'm going to show you the 120-year gold to platinum ratio. Here, I'm going to move me over to back to the left here real quick. Here's the gold to platinum ratio. The star is where we are at this second. So we've been going in this big, channel, so to speak, and we broke to the upside and we ran quite substantially. We're at 1.63 or 4 or something like that. An anomaly in history, and we're still at that ratio today, and I'll show you in the next chart. But this is what the chart looks like. It broke to the upside and it ran for a while. I don't think this is going to continue. It's not going to continue forever. Platinum's too valuable to society and what we're going to use in the future of it. Now here's the real chart here. Real time. We went on up and we broke to the downside and we hit this resistance line, the trend line. We hit it and we kind of bounced back up. We're probably doing like a little bounce here and then we'll probably come back down and try breaking it at some point. I don't know the exact timing, but that's what it looks like. It is in an uptrend. It hasn't broken the uptrend yet, but more than likely it's going to. And when platinum outperforms gold, and that's when this goes down, is when platinum outperforms gold, it means something. And this is what it means. It says, this ratio has a better track record for predicting the stock market's direction than many of the more widely known valuation metrics. It's good news for stocks or favorable for equities when this ratio is increasing higher. That's when this guy is increasing higher. We've pulled on back here, and that's why equities have paused. That's why they look like they were all rolling over. And when this ratio goes down, it's unfavorable for equities. So it's not the level that we are worried about, it's the direction that it's going. If this is going downward, it's unfavorable for equities. When it's going upward, it is favorable for equities. Now, this is what it means. It says, consider an academic study by Darian Hung, a former finance professor at Cornell University, an assistant professor of finance and business, blah, blah, blah. They found that the gold to platinum ratio is a good stock market predictor. A falling ratio is bad news for equities, while a rising ratio is bullish. Why would the gold to platinum ratio be able to forecast the stock market? In interviews when his research first came out, he explained to me that it has to do with the different factors that influence the prices of these two metals. Platinum primarily reflects industrial demand, while gold's price reflects both industrial demand and as well as investor demand for a hedge against economic and geopolitical trouble. So when the ratio is rising, as it has in years, investors collectively are anticipating a rising level of risk. Equities must deliver a higher than average expected return as compensation for that higher risk. You might find it hard to square this hypothesis with the length of the recent economic recovery. The length is from the recovery phase in real estate, which is now the longest in U.S. history, and that's why it was the longest. At least in retrospect, it certainly doesn't seem as though there has been a higher than average level of risk. Now, if this ratio is going to fall from right here and break this trend line, we should see a setup in platinum that's going to explode to the upside. What do we have? Here's the platinum price that I pulled up. Big long-term chart. It broke this downtrend coming through. It broke that trend to the upside, platinum did. Now we're resting and trying to break through this one last pattern where you connect these two highs and come through. It's trying to break that out. Are we going to break it out? Most likely we're going to break out here. Copper already broke out. Platinum's going to follow. That's on the big pattern here. That thing breaks, platinum's gone. More than likely, it's going to have a massive move. Now, are we out of the clear where this thing's going to break yet? I don't know. Maybe we're going to pull back a little bit before we try breaking through. The timing is unknown, but that pattern is set up to break to the upside, not to the downside. And looking at that from a big long perspective, long-term perspective, you just hold on. You don't try trading in and out. You just get in and hold on. But that is signaling something. Copper already broke. More than likely, this will break. That's my guess. So that's the data I have. That's how things are tied together. Are we going to have a short-term pullback? I don't know. But your indicators are these things that I just went over. Those are your indicators. They work very well on the long term. The very, very short term, things are like flinging all over the place. So My approach is to buy these things that are undervalued. You could see those on the other videos on my channel. Click subscribe too, please. You can see that on my channel. I go over daily charting stuff, and I think that things look very good. And I don't know that these patterns creating these massive patterns that are 10, 20, 30, 40 years in length, I don't see how those necessarily could be wrong. But we'll see. We'll continue to monitor housing starts, inventory for real estate, and days on the market and prices. We'll monitor that. We'll monitor interest rates. We'll monitor the copper to gold ratio, the platinum to gold ratio, and we'll see what they're telling us. If you guys like this content, give me a thumbs up, leave comments below, and thank you for listening. This is Finding Value.